Good morning, everybody. Welcome to our Thursday Q&A call. Thank you for joining us this Thursday morning. We're going to be discussing Standard Bank, and we've got Pierre Miller, who's our banking analyst. He's going to be sharing some insights. Sean's going to do his normal technical bit, and then we'll take your questions. Can I just ask that you mute your mic when you come into the room? Thank you. And then I'm going to hand straight over to Pierre, and we'll fire away. Thank you very much.
Thanks, Sorrel. Good morning, everyone. As Sorrel mentioned, we're looking at Standard Bank today, and we'll also touch more on its first half-year results that it reported on its 2024 financial year. Starting with our executive summary, or just a look at the overall view. So in the environment, we've seen a recent strong performance on the Africa side of Standard Bank's business compared to SA. And we think this narrative might change a bit more to the SA side, or preferring the SA side. That's just based to the Africa region, let's say, having a higher base. We've also seen this in some of these results, such as the trading revenue, which we'll touch on throughout the presentation. And then also on South Africa's side, the outlook seems to be improving as we have more certainty around things such as what was the election outcomes, the load shedding, and those sort of things. On an interest rate front, so overall, across Africa and also South Africa, the expectations are for interest rates to decrease. Standard Bank is a bit more sensitive on its net interest margin to interest rates. So as the interest rate decreases, it should be earning a bit less of interest on its assets compared to some of the other peer banks, where some of them hedge their kind of interest rates, so they're a bit more stable, where Standard Bank is a bit more sensitive. However, there's also benefits when the interest rates decrease. So then the economic activity could potentially pick up. So on the non-interest revenue, that could potentially pick up when interest rates decrease. Also, it could the credit front, it could be there's more of a healthy demand also, and they're also a bit more comfortable to extend lending. So then the credit growth, and also on the credit quality, so the impairments, that can also improve. So there's a bit of these offsetting type of impacts that could happen as interest rates decrease. On a valuation front, Standard Bank is trading below the 10-year average on its PE multiple. However, it's at an average value, or if you look at a 5-year period. We have a buy recommendation on Standard Bank, so we still see some upside to our intrinsic value, and we think the positive narrative, especially in the South African front, should help some of the SA Inc. type of companies. Standard Bank has a bit more Africa exposure, but still we think that there's still a large portion, 50 or 60% of the business still South Africa, so it should benefit from that. But we change our mind if there's a increase in the risks involved with having exposure to these African countries, or in the credit risk. So the main expectations is for credit quality to improve as interest rate decrease. So if that doesn't happen, or if that dynamic where I talked about the interest rates decreasing, and you have this negative impact on the net interest margin, if that is worse, then the impairments, the loan growth, the non-interest revenue, positive, let's say, impact. But for the case being, we're still more optimistic and have a buy. So looking at the results, starting off at the net interest income, it grew by 7%. It was mainly due to the average interest earning assets being up 5%. So they are the loans and advances. So they issued more. So that was up 5%. And then on the non-interest revenue, that decreased 9%, mainly due to the decrease in trading revenue, which was down 16%. And then the results were overall also impacted by currency movements. So just to point out specifically the non-interest revenue and insurance and asset management income, that would have been faced some pressure. But then on the other side, also the expenses would have been, let's say, lower due to this currency movements as well. So also while we're on the expenses, it decreased by 1%, and then it also, you can say, they had good expense management as the cost to income ratio decreased as well. On the impairment front, so the impairments decreased by 15%, and that's due to mainly in the retail space where we saw the most pressure in the banks. They cited that there's already improvement in the earlier arrears that they see. So we're starting to see this benefit coming through on the payment. So you can see also the credit loss ratio, which is a measure they use to, which is basically your total expense compared to the total loans. The top of their range that they aim for is 100 basis points. So you can see it moved back below that 100 basis points, what they're aiming for. So we're starting to see the impairments already improve on that front. So this chart is a waterfall graph that they call it. So what I did here is just we look at the profit before tax prior year compared to this year. I'll just show you the main movements in between. And just some of these larger splits here, you can see if we look at the Africa trading income, that was the main detractor. And then also the Standard Bank SA, so the South African front, the net interest income increase was the largest positive movement on that side. As we mentioned there, that a good increase in the net interest margin and also in the loan growth. While staying on that net interest income and the net interest margin, here, this graph just shows you how it also increased the net interest margin. So as mentioned, the endowment impact, so a higher interest rate environment usually allows for more interest to be charged, to put it simply. So that's what benefited them. The 14 basis point decrease in that asset pricing in mix, it was mainly driven by a 10 basis point decrease of that 14 was due to asset pricing. And that they said there was increased competition in the home services business. So this is taken from Standard Bank's presentation that they did at the half-year results. And here you can see the expectation across these countries where they are operational, their main countries. Is the main expectation is for the interest rates to decrease in the near term. Now turning to the non-interest revenue. If we start off at that pie chart at the right-hand side, so I just like to show you a bit of the makeup of the bank's non-interest revenue. So most banks have quite a high portion of the net fee and commission. So Standard Bank, it's still a high portion, 40%, but it's not as large as the other banks. And this is due to Standard Bank having a very large trading business and also insurance and asset management business. And then looking at the results, what happened for the first half of the year. So the net fee and commission, it increased 4%. That's quite in line with what they said the active client growth was, which was 5%. And then the trading revenue, they said the decrease was mainly there in the fixed income and currencies, trading businesses, and that's off a high base. And we also saw that in the last year results, it had a large increase back then. So it's kind of just, it's normalizing on that front. And then in their insurance and asset management business, so the main reason for that decrease or that they experienced on that front was especially in the asset management side and especially in the Nigerian business, as there was a devaluation in the Nigerian naira. Now turning to operating expenses. So as mentioned, they had good cost management in the sense of their cost to income decrease. So their profitability in that sense decreased. And it looks like extremely well, let's say cost management in the sense of it was down 1%, but this is due to currency movements. As that first bullet point, you can see expenses actually increased by 10% if you use the constant currency. So a lot of these African countries have very high inflation rates. And then for all banks, usually the staff cost is quite the largest portion and the expenses. And when looking at the staff costs, so the headcount increased slightly by 2%. They had the annual increases and also a bit more of a more expensive employee mix. This was offset by the incentive and shares scheme cost decreasing, and they said that's due to the group performance and currency impacts. If we look at the price performance, so over especially a 2-year period, Standard Bank performed extremely well, outperforming the benchmark. And then if we turn to the valuation front, so we increased our intrinsic value, so we still see upside. So the reason for the increase in our intrinsic value, one portion is the earnings. So we still see there's going to be earnings growth that's going to help the business. And then on the PE multiple that we applied to it, we also increased that because since last, our previous estimate or intrinsic value, since then, we now know what was the election outcomes compared to the uncertainty back then. We also, back then, there was more uncertainty around if inflation will come down and will interest rates decrease. The markets are thinking more towards decreases now. So a lot of these things are playing out favorably, and also some of the South African other type of impacts like load shedding. We've seen a lot less load shedding in recent times. And then because that previous chart was a 5-year, it looked at average, in the average level. So if we look at a 10-year view of this, so the right-hand side is a 10-year PE, and then that the black line there, you can see that's the average. So it's 9, usually is the 10-year average of Standard Bank. So it's still below that. And then the left-hand side is if we take what the average analyst out there forecasts its earnings per share times a 9 PE. So then we have that history of that, and then you can see that blue line represents the type of fair value or intrinsic value in that sense, how it's calculated. And you can see the black line, the share price, is still below that. And we think, the things shouldn't always just be at the average, because you have worse times. Let's say in South Africa, you go into heavy load shedding, and then you have better times. So our view is just, I think it can actually go a little bit above the historic average, and that's why we have a upside still. And that brings me to the end of my side. I'll now hand it over to Sean, who can take us through the technical side.
Yeah, good morning, everybody. Yeah, you can see the chart of Standard Bank. That was yesterday's close. Yeah, you can also see there that the share price is trading below its 200-day moving average. That's that little red line. But it's still trading far above its 50-day and 200-day moving averages. Saying that, obviously both the medium and long-term trends still remain bullish. But in the short term, you can see yesterday the share price did break down below a support trend line to trigger a change in trend in the short term. So I'm anticipating maybe it could pull back towards that 50-day moving average, and might bounce off from there. It also might pull back into what I call the zone, that's, you can call it the resistance zone. That's between around about 218 Rand and 208 Rand levels, which would act now as a new support level. But from there, I think it will rebound higher. And this short-term bearish price action is confirmed there at the bottom by the MACD indicator. It is trading in overbought territory, and is also trading below its call it the trigger line, so it is also bearish. But saying that, other little indicators like stochastic and that, not showing on this chart here, are already oversold. So as I say, anticipate a rebound soon. And as Pierre said now, you can see right up top there, that recent resistance level, that 243.80 level, that is the all-time high, and we've still got our intrinsic value far above that at 281. So hence the buy recommendation. So a lot of upside potential, but I'll wait until see what happens where it will rebound, where it will stop and turn around. That's me.
Yeah, I think these banks are having a fine time. We're all experiencing a tough economy and so on, but it seems the banks are just bumping along here. We had Nedbank the other day, and they're doing fine, and Standard Bank seems to be doing fine. They have these banks don't have as much exposure to interest rates on their income statements. So even though we're expecting rate cuts to come as soon as next week, I don't think it's going to impact them much. But looking at this technical chart, it might just be the right place to pick up some standard banks, because it looks like it could pull back to around 215 or so, which is that blue line, that resistance level that it broke out of. If it does dip down to 208, it's a no-brainer. And I think, yeah, a very good buy with a much higher intrinsic value. It looks like the consensus expectations for inflation next week, it's due out on Wednesday, the inflation numbers, and it looks like everybody's expecting it to have dropped to about 5.1%, which is, and then the forecast for 2025 and 26 is for it to be down below 5%, which is what the Reserve Bank wants. And I think we might see a rate cut coming as early as next week, Thursday, when we have the Monetary Policy Committee meeting. So let's hope for that. And then, like I say, keep your eyes peeled on the banks, because they will certainly dip when the rates get cut. But when Standard Bank hits us 215, or maybe if we're lucky 208 level, then definitely a good buying opportunity. I'm going to hop straight into the chat and see if there's some questions there. Richard says, do we see more value in Standard than in ABSA? Pierre?
No, I see ABSA is my favorite. We're still waiting for that to play out. But yeah, no, I prefer ABSA. So if I just take the the overall, let's say a couple of items overview of it. So on a valuation front, ABSA is cheaper. It has a lot more, let's say, already negative news priced in. So there's a lot more potential for positive news to flow in. So the valuation front is cheaper. And then also, if we look at that net interest income where I talked about, so Standard Bank is sensitive to interest rates more than ABSA. ABSA hedges their interest rates, so it's stable. So when the interest rates decrease, it's not going to face the same pressure on its net interest income. So on that front, I'm also more positive. And then this one sounds strange, but ABSA has higher impairments at the moment. So yes, that's a negative thing. But if the interest rates decrease and the economy, let's say there's less load shedding, business doing better, and if the consumer, with lower inflation, lower interest rates, and that helps them, and you see improvement in credit quality, so less impairments, it should have a larger, let's say, normalization back to the norm impact for ABSA, because it's currently more negative, so it should improve. So that's three type of main drivers that I would say is the difference between these two. On the Africa side, both of them have a lot of Africa in their business, so that's quite the same.
Okay, thanks, Pierre. Yes, that's a very good take there on ABSA. So you clearly prefer ABSA. I don't think you can make a mistake by buying Standard Bank, though. And as I've stated, looking at the technicals, and you've mentioned it now, it will pull back once the rates drop, but then it's probably the time to buy. James says, any information on the BRICS alignment and speculation about the new BRICS trading currency, and how would that benefit Standard Bank? You know anything about the BRICS
Sure, no, I
currency and
don't.
that?
No, actually I don't. But my thinking is more currency trading should on the trading business maybe do well for Standard Bank because that's such a. But also, just my thinking is, a BRICS currency and all of that, how long it will, take to really, become like the new currency. That's also probably something one would have to think about.
Yeah, unfortunately, James, I don't know much about it either, but I think we'll try and find out and keep our ears peeled for news on that front, and then we'll update you in future sessions if we found out something about it. Then Frederick says, any take on Investec versus Standard Bank? Wow, interesting one. Yeah?
Yeah, so I think Investec is usually also a good bank to invest in, but I think the timing now for me is not right. So if you historically look at when inflation and interest rates decrease, apologies, when inflation and interest rate increase, so when it's going up. So the period that we've have been just in now. So then the markets and everything goes a risk-off approach, and you usually see, usually then your rand would also depreciate as it's a higher risk type of country. So you would, in that environment, actually want to be in Investec because Investec has a large UK business. So when you are, let's say, you prefer offshore or you're anti-SA Inc., so to say, then you would go to Investec. So for now, because I have quite a optimistic view on the SA Inc. type of play at the moment, I would rather stay, stick to that your type of your more local type of banks, Capitec, Standard Bank, Absa, and FirstRand.
Do we know how much interest rate exposure a bank like Investec has? And specifically the PLC, if the rates start coming down around the world, will it impact Investec in the same way that it will Standard?
Yeah, I think all banks, even those that hedge, are impacted by lower interest rates. Some just takes a bit longer or have less of an impact. So technically, it should also impact Investec. I think, however, the Investec, let's say the view on the other type of items, impairments, that could be different. But I think on the net interest income, it should have also a negative impact.
Thank you, Pierre. Nolan says, is the latest SA inflation rate not 4.6, not 5.2 like I said? Nolan, the reading in July year on year was 4.6. That's correct. But they're expecting that reading to come down. Well, the year on year one, the average inflation forecast for 24 will come down to 5.1. That's the 5.1 number that I used. So yes, you're right. The midpoint, the year on year was 4.6 in July, and it was within a whisker of the target of 4.5%. I don't see any other questions. Anybody else has something? Yes, thank you, Pierre. You've given us some good insight, mate. So there you have it. Pierre fancies Absa over Standard Bank. Doesn't think Standard Bank will do badly. On the technical side, we have fairly clear levels on Standard. But all in all, the bank's doing fine. And we're expecting a little bit of a gift from the Reserve Bank next week. Thanks for joining us today. Thank you, Pierre, for sharing your insight. Much appreciated, mate. Thank you, Sean, for your contribution. Thanks for making these technical charts for us. It's nice to have a look at them, and we'll see you guys next week. Next week, I think...
Harmony.
Are we back in the gold miners? Good. All right. Great. So we'll do Harmony next week, and we'll see you same time, same place. Have a fantastic Thursday, guys. Cheers.
Cheers.